Hi, good night. My name is Africa Godsmore, and I will be giving you an overview of the foreign exchange market and how is it linked to international trade. First and foremost, the foreign exchange market is a global decentralized market for the trading of currencies, which is where you buy and sell currencies, right? This market determines the currency, the foreign exchange rates for every currency, right? You would hear persons refer to this market as the FX market or the Forex market. Also, for example, what happens is that I'm in Jamaica and I am in Jamaica and I would use my Jamaican currency to purchase US currencies, right? So bear in mind that there are several types of foreign exchange markets, right? But there are two broad categories, which is the spot market and the forward market. In the spot market, what happens is that the prices for a product is traded. They determine the prices of a product that are traded immediately, right? For example, the stock market. For the forward market, what happens is that this is where items or products that would be traded in future. So they come to an agreement. It is solely for items that would be agreed upon or traded at a later date. For example, a farmer has some crops and he doesn't know the prices of the crops, right? And he would actually say, for instance, 3 months after reaping, he doesn't know the prices of the crops. What he would do, if he speaks with a buyer on these crops, he would basically think about what price he would sell these items for, right? And in the later or in future, so he would come to an agreement with the buyer to sell the items for a specific price, say for instance 3 months in advance before he actually completes the transaction, right? Also, what I want to do is that I want to divert more into how foreign exchange market affects the international trade, right? So suppose you have the US to JMD exchange rate. US to Jamaican dollar exchange rate is $152, right? And a US resident comes to Jamaica and he wants to purchase a watch for $5,000, 5,000 Jamaican dollars. You would have to trade, you would have to purchase, or you would have to give up 32.89 of his US dollar to get that watch. And likewise, if I go to the US, right, and I purchase a game for $50, because the exchange rate is 152 Jamaican dollars, right? I would need 7,500 Jamaican dollars to get that watch for $50 US, right? So say for instance, the exchange rate for the Jamaican dollar goes up to $160, right? What would happen is that the resident that wants to purchase that particular watch, he would actually need 31.25 of his US currency to purchase the watch for $5,000. In this case, the Jamaican dollar appreciates, right? Whereby it gets stronger. It really does get stronger. So in international trade, the exchange rate will affect import and export, right? So when the local dollar appreciates, it gets cheaper for US consumers to import foreign goods and US exporters to other countries to get, if it's a case where US is exporting to other countries, it would get more expensive for them to export these goods, and vice versa. If it's a case where the dollar depreciates, it's a case where local currency would get weaker, it would take more of that funds, more of that dollar to actually, more of the currency to purchase that item. So thank you for, that's basically the overview on the foreign exchange market. Thank you for listening. Bye.